Hi, welcome to the Market Alert for Wednesday, the 12th of August 2015. And starting off in the 5-minute chart, you can see that the market started to fall in the pre-market session, down over 100 points to start with. And then in the afternoon session, the official time from 2:30, you can see the market there wanting to move lower. But the market brought back by the professional, stopping this trade out with a 40-point loss before the market eventually gave another sell signal and then moved lower, trading down to the 17,400 level. You can see the market going through this. It drove straight through it, reversed, and then came back and then continued lower once more, recouping the loss of this trade. And had you have held this one with the weakness in the background of this market, which I'm going to come to in a moment, you will have seen prices eventually trade down to the 17,350 level, which was around 80 points on this. We've certainly got the weakness in the background, and for the second consecutive day the Chinese have weakened the yuan. And you can see the effect of this, the market trading down even further to 17,300. You can see the buying pressure coming into the market here with the test bar as well. And this now holding the market at this crucial level. If you have a look at the daily chart, you'll see what I mean. 17,276 is where the market found support on Friday, and then of course Monday we saw the market move up. Yesterday we see selling coming into the market. This market is definitely showing signs of weakness now. The cracks are appearing, and any rally that we get off this market is definitely going to be a sell into it. The tide has turned from the bull market, but again I'm going to come to that in just a moment. But just let's look at the technicals first. So the market got a hold above the 17,276 level. A break below there, we'll see prices move lower. As I said, on Monday we had the market rallying. This was on low volume. This is prices being held by the professionals. Yesterday you can see them selling into that, and the market of course being marked down. The futures markets pushing prices lower on the overnight. If you're wondering what these two averages are, these are the 50 and the 200. This is what's used by the banks and the institutions to see if the market is bullish or bearish. And when the 50 crosses the 200, it's known as the death cross. And the last time this happened was back in 2011. Prior to this, you will see the 200 moving average when prices trade to it, closing back above it, and once they do, continuing higher. It's a very, very good long-term indicator, but now you can see that this time not only have prices closed below it, but the 50-day average is closed below the 200 as well, giving that death cross. But if we go back, the last time this happened is in 2011. You will see it here in October. Well, actually it's before October. Let me just get you the correct date. It's August, funny enough, happens to be August, and then you see prices trading below that for a while. We get this double bottom, and then prices moving back to the upside there. There you can see it happening again as well in 2010, and then that's as far back as we go. So an interesting one to keep an eye on at the moment. We've certainly got this cross through, and what we're looking for is any failed rally to the upside. Now, what's going to cause a rally to the upside? Well, believe it or not, because the Chinese have devalued the yuan for the last 2 consecutive days, this has had a major impact on the US dollar. It's actually rallied, and it's already in a bubble anyway. This is going to have a negative impact on exports for the US, and of course what this is likely to do is to set off some sort of a currency war. That said, the US cannot just devalue the dollar like the Chinese have done with the yuan. So what is likely to happen, in my opinion, because they keep vacillating on interest rates, Yellen doesn't know whether it's Christmas or Easter when it comes to actually making the decision. And the more they leave this decision, the bigger the impact this is going to have with the US dollar, i.e. it's going to continue to rise. That's going to create a major economic problem for the US. So don't be surprised if Yellen actually goes and prints more money. The economic figures coming out are showing the economy slowing. Obviously, the Chinese economy has slowed down considerably, which is why they're devaluing the yuan. So when you look at the fundamentals, it's surely a case that there's likely to be more printing by the Fed, QE4, than there is to actually see an interest rate rise. Unless, of course, they decide that the 18 trillion they've already printed hasn't done the trick, then why not bother and just go for an interest rate rise, which would have the effect, though, and this is where they're painted into a corner now, of actually increasing the value of the US dollar. So again, they're not going to take that option. They're probably likely to print more money on the pretext that they had no choice because of the devaluation of the yuan, and also that the economy was slowing down and it needed another injection of capital. Of course, this is a bit like giving somebody that's on heroin a bigger fix of a drug to actually get the same effect as before. So it'll be certainly interesting to see how this starts to unfold, but certainly the short side of the Dow, apart from the odd day or two that you're going to see a rally to the upside at the moment, is the best side, which is why when you looked at the 5-minute chart, better to hold the short trade than the any buy trade after the Monday one, which I spoke about when I recorded it, saying you can expect an update, which we got, but it was only prices being marked up and short squeezing those that were already short. So just going back to the daily chart, let's have a quick look at the news. I don't think there's anything out apart from crude oil at 3.30, and of course this is now at multi-year lows, lost over 70% of its value from the highs. We've got the job openings there at 3 p.m. Medium impact, but other than that, we'll have to wait and see. They're wheeling Dudley out from the Fed to speak at 1:30 p.m. as well. That will be interesting, no doubt. We're saying everything's fine. Don't worry about the Chinese devaluing their currency. This is the usual rhetoric that we saw in 2008 before we had the major correction in the markets to the banking following the banking crisis. And everything is setting itself up for that same picture at the moment. 13-year lows in commodity prices, US dollar rallying, gold prices trading sideways. The only difference is we've got bubbles in the bond market in the US dollar to add this time to any major correction as well. Right, let's have a quick look at the implied volatility. It's 1333, up slightly, as you would expect, the market being down yesterday. So again, this is going to increase as we see the pressure to the downside. And I wouldn't be surprised to see the market accelerate to the downside either, as we need a big shakeout in this market before it can move or even think about moving to the upside. Unless, of course, the Fed turns on the printing presses again and prints another trillion to keep the economy and the illusion alive that everything is fine. Right, that's it for this morning. I will see you in tomorrow's edition of the Market Alert. As ever, thank you for your support and also for watching. See you in the next one.